Now that we have some basic life insurance concepts, let's talk about some options that can be endorsed on a life insurance policy. Different insurance carriers may have their own variations, but there are a few common ones that we should look at. This is an endorsement that allows a customer to stop paying on their policy but continue to have coverage when they become disabled. Each insurance company will have their own definition as to the qualification of disability, but generally there is a waiting period before the insurance carrier will waive the premium payment. Depending on the contract of the policy, the waiver can be until the end of the term it is reached. On the other hand, there are contracts that will extend beyond the term and can last a whole lifetime. There are also contracts that will convert a temporary policy into a permanent one if the disability becomes lifetime. An example is if a person becomes disabled and remains that way past the age of 65. The policy is converted from a term policy to a whole life product and the premium is waived permanently. This is a great coverage as it allows the customer to continue to have coverage even when they are unable to work and can't afford the payments. Of course, depending on the premium for this endorsement, it can be prudent to purchase an individual disability policy to take care of this cost. Decision to purchase this coverage usually needs to be made at the beginning of the policy and cannot be endorsed in the midterm of the product. This is an endorsement that allows parents to purchase a small amount of life policies on their minor children at a reasonable cost. Once endorsed, the policy will last until a certain majority age defined by the insurance carrier. Coverage offered will also vary by the different carriers and is charged by the face amount. Generally, the charge is by the coverage amount, not the number of children, meaning by endorsing the coverage on the policy, all biological, legally adopted, and stepchildren are included. Many insurance carriers will also offer the option that if the child on the rider becomes disqualified for the rider because of age, they can convert that policy into an individual policy without going through underwriting, provided that the face coverage amount is the same or less. New children born, adopted, or become legal by marriage, a window of time is permitted to have them added to the policy. This endorsement allows a customer to increase their life insurance coverage by a specified amount at a certain age without having to go through underwriting requirements. Every company sets their own rule or offers it at all, but if available, this is a great endorsement to allow a customer to increase their coverage in spite of future health risk. How it works is that the customer would choose an increased amount, for example, $50,000. Of course, the higher the coverage, the higher the premium. The company will set when a customer can choose to increase coverage, for example, at age 21, 25, 30, 35, etc. On the anniversary of the policy at that specified age, the client then can choose to increase the coverage up to that specified amount, in this case $50,000, by just signing an agreement without having to go through underwriting. This is a great option for those whose family have a history of health issues, know that they have higher need in the future, or just want to ensure that they have those choices regardless of the unexpected. This endorsement provides for extra life insurance coverage should a person die or lose their limbs in an accident. It is a common endorsement that is not just seen on a life policy, but can also be found as an individual coverage on products such as bank accounts and property and casualty policies. Premium on these policies are very reasonable, even for older people, but the customer has to clearly understand the coverage is only provided if they die or lose their limbs in an accident. I'm not too much of a fan of this type of coverage, as I believe when a person buys life insurance, they should make sure that proper evaluation is done and coverage amount should meet the needs of the family under any circumstances, not just in the case of an accident or dismemberment. There are people who have a hard time getting coverage because they don't meet underwriting guidelines and prefer to purchase this type of policies to at least have something. In such cases, it tends to be smaller individual plans that do not have underwriting requirement. I have also seen people go through this route because they don't want to take health exams, though again, they would have to die of an accident or have loss of limbs in order for the family to receive benefits. Though you don't hear much about this rider, some insurers make it available to provide for the surviving family a stream of income. Usually, this coverage is endorsed on a term policy and the payout is for a specified amount of time chosen by the insured during the term of the policy. A lump sum may become available at the end of the policy period if there's a balance left over from the monthly payment. This type of endorsement allows the customer the peace of mind that their loved ones will continue to have a stream of income upon an unexpected death, and the family member does not have to worry about the logistics as to what to do with the lump sum payout. Should the insured survive the term of the policy, some companies will offer the ability to convert the policy into a permanent plan so that coverage can extend long term. This rider allows the insured the opportunity to withdraw benefits prior to death if they are diagnosed with terminal illness. Usually, the amount of withdrawal is a percentage of the total death benefit, which will be subtracted before the total payout is settled with the beneficiaries upon death. Usually, there are no charge for this type of rider and is designed to allow flexibility for the insured should a terminal situation occur. This rider is endorsed on the policy to allow the insured to draw against the death benefit should they need long-term care. The amount will be drawn against the life policy and death benefit will decrease from the withdrawn amount. Though this may be a good option to allow flexibility of drawing against the death benefit, the insured need to consider carefully as the withdrawal for long-term care will affect what the family will receive upon the insured's death. To meet both the need for long-term care and life insurance, a larger policy may need to be purchased, but this will equate to higher premium. A better alternative may be to purchase an individual long-term care policy and keep the life policy intact with coverage that meets the family's life insurance needs.